All right, welcome to another meeting for the Investment Club. This is going to be something of a, at least at first, not the whole meeting, but just part of it, bit of a update, look into the market, what's going on, checking in on that front, and talking about a couple different perspectives here. So, I believe what we can, as far as looking at like currently, and there's past crashes, we can see the same sort of three segmented pattern that we've been talking about, lasting anywhere from a month and a half, a month to 2 months. At this point, seemingly consistently, we're going a month and a half. The thing is that at this point, we're only like in the first like third or something like that of this month and a half sort of segment. If this is what we're doing, it does look like that's what we're doing. The thing is that the crash that we were referencing, particularly at this point when we started coming back down here, and we're fulfilling now more fleshed out that third segmented part, what we were referencing out of all the different sort of corrections that happened was the Great Financial Crisis for the SPY specifically. And what happened at that point, and how it maps onto here, is at the highest point for the third segmented part of the SPY back then, the highest point was on the earlier side about a third of the way through that period that it had. Back then that was 2 months, but regardless, we're kind of looking at proportions here. We're kind of wanting to see about like ideas for if there is something of a mapping on and it's supposed to be like a 1-for-1 sort of thing. If we can make them equal, then where does the time lead us to go? And at that point, we can kind of see like here, we should possibly consolidate. We might go higher, but at this point, we're not really going much any further. On top of that, there's that perspective. We can also look at the technical analysis perspective, which just in that sense, looking at resistance lines here, they were support lines. As soon as just looking at like general law of technical analysis, you can see support lines showing up, support areas. And then when you see a crackdown through that, these all of a sudden become resistance areas. It's the nature of buyers and sellers and where they are at. You can also look at volume shelf profiles and that sort of thing, but we don't really quite have to look at those just, at least in this case. Regardless though, there's a lot up here. There's also a sense about it that when we looked at the Great Financial Crisis, that it came up to, we can say the third segment had its highest point, coming up to the, if I can show you guys, it might actually be a lot easier. Oh, I can't do that, weird. Anyways. 1 moment here, I'll be able to show you, it'll make a lot more sense. So the third segment here, right, as it's shown, came up to about the middle section, sorry, here, up here, it's a little higher. There it is. Came up to about the middle section here of we want to say the first segment here, that middle section right there to the very bottom of that, again mapping up to a support area right there. And we can see right here as well that currently it is about, we were thinking originally that like, oh, it would be coming up to like the middle section here, but here now, in a sense, again, this is something of a stretch even for me to say, but it's also possible just given like the other things that I've talked about. But this right here, if we think about, there's 3 points here that we want to talk about when we look at this first segment right here. There's this point right here, this point, and this point. This point right here is the middle point between all the points right here, right? These collective 3 points. We were just looking at before that the first segment during the Great Financial Crisis went up to the middle section of the first segment, right? We were thinking originally here, just being the middle segment. Now we're looking at, in a sense of like, price action, so to speak, of a middle section here for the first segment. But again, that's even for me a little bit of a stretch. If it weren't for the other factors involved here, talking about proportionality of like how long is this supposed to be going on for, and then also like technical analysis with support lines, I'd say that's something of a stretch. But honestly, at this point, it's actually quite possible. Now, if we do actually go beyond here, we're looking up here. That'd be about it. Now, if we go beyond that point, then we're gonna have to have a different conversation. But at this point though, probably not. There's not a lot supporting anything like going up beyond here and something way unexpected bull rally. It's not very, looking very possible, but we could very well go up to here. Regardless, at this point, it'd be almost too quick unless you wanted to trade like intraday or something like that to be able to be like, oh, well here, let me like reassess my portfolio. I might be trying to do that myself, but for you guys, honestly, you don't really quite have to worry about it. If you're still putting in money in, that's fantastic, that's great. Stretch it out over another few days, you're gonna do fantastic. We'll talk about this again in 3 months, and we'll be looking back being like, nice, that sort of thing. Beyond that, I just want to give that sort of quick update on the markets, but in particular, if anything, proportionally speaking, timing-wise, this area right here, time-wise, right, is seemingly about, very possibly at least, for an idea of where we could have a topping out, and then also technical analysis, that sort of thing. But regardless, we'll see what happens, but things should be fine. Okay, so the other thing I want to talk to you guys about is something called, actually, you know what, I'll save this till the end. Yeah, you know what, I'll just say it really quickly right now. It's real quick. So, okay, so I'm just gonna read this out. So the Affordable Connectivity Program, I'll have that in the description of the video, I'll have it like spelled out. The Affordable Connectivity Program, it's a federal program. This was news that came out, so I'm just letting you guys know about it. Alongside 20-ish companies to provide free internet to those qualifying persons based on income. Eligible households can also receive a one-time discount of up to $100 to purchase a laptop, desktop, computer, or tablet from participating providers if they contribute more than $10 and less than $50 toward the purchase price of such devices. So you guys can get like free internet. This is a federal program that's going on right now. Here's another one too. California state officials in April launched a new program that lets first-time homebuyers borrow a down payment at 0% interest rate. The program, the Forgivable Equity Builder Loan, provides forgivable loans to home buyers for up to 10% of the home's purchase price. So that's a quite large margin. Again, if you look at down payments, usually they're going to be between 5 and 7%. Conventional home loans, FHA's 3.5%. For the California, state here, back in April, they're going up for 10%. So there's that. It's forgivable. There's no interest. That's free money. Right now, again, with the housing market and all of that, you could. I've seen other perspectives, particularly with what my mom's doing. She actually just recently got a house, but it was over in Atlanta, Georgia, so a bit of a different situation. But there is a possibility you could say that like, while the market's going down, if you're renting out, the money you're being able to make from the rental income makes up for the money lost in equity of the home. But that's sort of a more specific conversation you have to have. Regardless, that sort of program is likely, I would say, not to go away for any time soon, So if you guys wanted to wait a few years, you're probably gonna do just fine. And then on top of that, remember you have that sort of thing going on in California. Okay, now let's get into this one. So this is sort of, okay, so first of all, let me tell you guys about this dude's name, Wall Street Millennial. So it's gonna look really like Reddit-y, like what the fuck is this guy talking about? Like, this is kind of sketch. He actually does the math and he does it pretty thoroughly. In fact, there's a part where we have to skip it just because it's like, this is just pure math, and also we don't really need to hear this because we can look at the chart and what it did. Anyways though, very interesting video. Why am I showing you this? Kind of twofold. One of them, we've talked before about like, oh, but what happens if it was like this much money? And I'm just realizing right now the lights. Hold on a second. Is that like okay?
Maybe not the.
No. Okay, all right. The lights are a little better now, presumably. Okay. So before we were talking about like, if you put like this much money in and you were looking at this certain CAGR, compounding annual growth rate, right? Looking at like how much your money actually grows year by year. We talked about a formula. If anyone has any questions about like, but what is the formula? I can, I'll put it down in the description or something like that. Anyways, it's a really simple formula. I believe actually, if I could just like say it off the top of my head, if I remember, it's the end amount, let's say it like whatever your investment goes to $100. $100 divided by the beginning amount, let's say it's $10, right? Parentheses, and then it's 1 divided by the number of years. And then you put that in, and then that should give you your compounding annual growth rate. Anyways, so we were looking at before about like, well, how much money could you like possibly be making with these sorts of things? He gives really good clarity on like, here's actually how much money you could be looking at. And on top of that, presumably that you held through all the different crashes that have ever happened. We don't need to do that, so it's even better, and I'll comment that as well, so just that part really quickly. And then number 2 here, why is it, and I've seen this so many times myself, and I'll talk about this too, I think, as soon as it starts, but why is it when you look up, on the internet, leverage ETF, should I invest? They'll say, no, don't do it, too risky, don't do it, right? We'll be talking about why that's a thing. There's a good reason why, and not good as in like, wait, they actually have good standing here, but like, there's an incentive.
What's up, guys?
Just saying really quickly, by the way, I'm gonna be standing like here in the corner just because I noticed last time it goes like, blurred, gone sort of thing with me out of the, anyways.
Welcome to Wall Street Millennial. Before we get into the video, keep in mind that we are not financial advisors, and this video is for
Okay, there's like an echo. You guys hear that too, huh?
That's weird.
Oh.
There's latency going to those speakers.
Yeah, maybe it might be that because there's like 2 different. You know what I mean? So let's see if that works.
Entertainment purposes only. Make sure you do your own research.
But now it's kind of like quiet. Hold on a second. Let me try this really quickly.
Turn on tier 1.
Uh-huh. Okay. Never mind.
Oh, wait,
Yeah.
professional before making any investment decisions.
God dang it. Okay. Sorry, guys. All right, here.
This video is not an endorsement of any investing strategy or product. No financial advice should be taken from this video. The stock market is widely considered the greatest tool of wealth creation in human history. Since 2008, the stock market has seen a tremendous recovery, increasing at a compounded annual return of roughly 15%. This,
By the way, historically, that's anomalous. In other words, like that 15% is usually not a thing that happens. It's like on average, you could say over the last like few decades, more like 7% or something like that. But it's 15 here because we've had like an amazing run. Regardless, though, not too big of an issue because we're looking at a longer time span than just simply like 10 years. So don't worry about this too much. I just wanted to make that a note. Like, don't expect 15% as like a normal thing. Understand context here, just because I think it's important. But regardless, you'll be fine. So don't
this
worry.
means that if you put in $100 into the SPY and reinvested the dividends, it would have turned into $570 today. However, what if I told you if there was another investment strategy that massively outperformed the S&P in the past decade? The blue line represents an alternative strategy, and the red line represents the SPY. As you can see, the SPY's returns look minuscule compared to the blue line. If you invested $100 into the SPY and the alternative strategy in 2008, the $100 in the SPY would have turned into $570 today. However, this is dwarfed by the $2,700 it would have turned into with the alternative strategy. So what is this investment strategy? Is it Warren Buffett's godly stock picks? Is it a complex hedge fund strategy? It is actually an extremely simple strategy that is not either of those two. The investment strategy that outperformed so much over the past decade is simply the Direction Daily S&P 500 Bull 3x Leverage ETF, ticker symbol SPXL.
Oh, god dang.
If you're using useless retail trading charts like this,
The SPXL seeks daily performance of 300% of the daily performance of the S&P 500 index before fees and expenses. Importantly, the fund does not seek to achieve this 300% target for a period of time different than one trading day. We will get into exactly what this means later. SPXL achieves its leveraged daily returns by investing in swap agreements and futures contracts, which are intended to produce economically leveraged investment results. By using these financial derivatives, they achieve the desired exposure without technically owning shares in the SPY. You might remember Bill Huang used a similar strategy to gain massive amounts of leverage in Viacom and other stocks for his hedge fund Archegos. When evaluating any ETF, it is important to look at the fee structure. SPXL charges a man.
So yeah, this part really quickly, not something you really need to worry about or honestly even really know too much about. I mean, you can certainly look at it if things do change, or I mean, again, that wouldn't really be likely, but if things were to into the future, so to speak, and you're looking at ones like, oh, well, this one's really closer to this one. There's like maybe a smidge of difference if you were to like, oh, this one does a 1.09% annual like fee, and you know the other one you're looking at is 1.03 or something like that, right? So you know at that point like it may be making something of a difference, but don't really worry too much about this. And also, by the way, what this means just really is that at like on average, that at like the end of the year, because it's based off of like so it really well, you know, let's say that. But anyways, point is they base it off of. He'll say it as well. they take their fee like on a day-to-day basis, but it's by like a real smidge. At the end of the year, it should amount to, because they you know rebalance and all that sort of stuff, it should amount to what it says here at the very bottom, which is 1.01%. Right, hopefully you guys can see that 1.01% after like all these sort of things are calculated. Anyway though, but what happens though, it's not that they take your money from you or anything like that, it's just that the price of, for example, XBXL is going to go down, you know, it would go down by like, I'm trying to think about how to phrase this. The point is that it's going to go down by 1.01%. You know, it's going to be lower by that much than if it were to have not, you know, had that fee taken away from it. Does that make sense? It's just going to have this amount taken away from it. That's the only point. But it's 1%, so don't worry about it. Anyways, we might be able to skip this part, but
Management fee worth 0.75% of the invested amount on an annual basis. They also incur transaction costs and other operating expenses that they pass through to the holders of the ETF. These transaction fees may vary, but they cap the total amount of fees at 1.01%. As reported by Investopedia, the fees are deducted from the net asset value of the ETF on a daily basis. You won't see the fees on your brokerage statements because the ETF manager handles them in-house. SPXL will not exactly hit its 300% target every day because there is a tiny amount shaved off each day for the fees. Also, the derivatives position that they enter into each day are subject to small sizing errors. However, it generally comes very close to the 300% target on any given day. There are many resources on the internet explaining the effects of 3 times daily leveraging on ETFs for investor returns.
So just to make something of a clear note on that one, these funds seek to multiply it on a day-to-day basis by 3, but that doesn't mean that they'll actually do it to a T, right? Because like what he said, like there's some sizing errors, you know, very very small things, but they get pretty damn exact.
Most of them say that 3 times leveraged ETFs are bad long-term bets and shouldn't be used by long-term investors. They cite discrepancies in performance between the 3x leveraged ETFs and what you might expect from them.
So before he goes on here, I'll make something of a preface here for why this happens, because I saw this myself, you know, when I looked into it, and you guys can too. When you invest in a leveraged ETF, okay, we're not actually putting money towards the companies themselves. So when we look at the SPY, right, the S&P 500, the SPY ETF, right, which is for the S&P 500, your money, you put $100 into that will get split up between all the 500 companies in the S&P 500. That's how that works, right? You put that money towards that sort of thing. The leveraged ETFs, however, have your money not go towards the companies themselves, but rather based on futures, contracts, options, and that sort of thing. Again, calculated on a day-to-day basis. That's how they function. Anyways, so there's that. So the reason why it would be a bad thing for people by and large to be like, oh hey, there's these leveraged ETFs, and I'm a long-term holder, right? They warn exactly against don't do this for the long-term holders. Not really, because again, there's other things you can look to as well, and we'll talk about this, about why their arguments are even less substantial than it would first seem. Anyways, so the point being about it though is that if everyone did this sort of thing and everyone was investing in leveraged ETFs, all of a sudden that money that would have gone, presumably, you know, in part, would have gone to the companies themselves are now going to these other things that are not helping the companies. And so what that means is that the stock market itself doesn't go as far as it could have gone, right? So the incentive is to say, these things may exist, but we're gonna put out a bunch of stuff to make sure that the majority of people don't invest in them. Because if they do, that means that our gains will be taken away as we are the ones because they have a lot of fucking money in the market, because we're the ones supporting the market, right? We will get less return on our stuff because now all these people are going for this sort of backdoor loophole almost sort of thing, which is almost seemingly what it is, right? In a sense of like, damn, that's effective. And again, you remember the chart that you showed between the two, but anyways. So there's a great deal of incentive for that sort of thing. That's why you'll see a lot of it for the Fool, for Investopedia, which is what we're looking at. Very reputable sources. They have actually a lot of incentive to make sure that people are not aware of or investing in these things they're scared away from, investing in these leveraged ETFs. That's just one part. You look at the specific arguments that you use, I'll point these out. They're not good arguments, but you'll see.
For example, in this Investopedia article, the performance of not even a 3 times leverage ETF, but just a 2 times leverage ETF on the S&P, the SSO, is compared to the performance of the S&P. The article says that the S&P was up 3.6% in 1 year in 2009, while the leveraged ETF was not up twice the S&P, and was in fact down slightly over the course of that same year. Leveraged ETFs are rebalanced daily, so the 3 times ratio should not be expected to be maintained over periods of time more than 1 day. As a result, the positive 3.6% return of the S&P 500 over the course of 2009 should not make an investor expect that the 2 times leverage counterpart would have 2 times the positive return, or 7.2%. However, that should be well known by educated investors. So let's take a closer look at why these articles say that this phenomenon exists.
Might not do. Okay. That argument that they gave, that's a logical fallacy. It's called cherry picking, right? It's a logical fallacy. There might be like a different name for that sort of thing, but I think most people know it by that sort of name. Or straw manning, that's actually, I think probably would be the name for it, but anyways, we're splitting hairs at that point. Regardless, the point is this. When they gave that example of like, here's this real world example, here's what happened. See, look, it was flat when the S&P 500 went up, right? Okay. You were looking at a small section, very, by the way, involving the great financial crisis, right? Because remember, these things are, in a sense, more volatile, right? They move, more strongly. So if you're involving a crash at the same time, it may very well not work out, right? That sort of thing. It was like, oh, hey, it was flat when this thing was going up, right? But again, this is exactly, which is the greatest irony of it all, is that this is exactly a long-term viewing of when we look at these things. You don't want to look at the specific moment because that will be cherry picking, as they showed there, right? But look at the long term. What did it do over time, right? And you can see the comparison there, as we did before, and you'll do it again too. There's a great deal of difference there. So when they say here's a specific time, that is cherry picking. That is cherry picking because we can look at the picture. When people, as just sort of a general idea here, because I think it's meaningful to comment on, when people look at this entire thing and they say, that right there, that's the truth, that's what I want you to look at, right? They take a piece of the truth, a small piece of the truth, mind you, that's cherry picking, right? That is effectively a lie. That is effectively a lie because it is misleading you into thinking that this part here is actually this entire thing.
The reasons commonly given for the lagging performance in 3 times leverage ETFs in certain market conditions are usually explained by theoretical examples. In this Motley Fool article, the author asked the reader to consider a stock index that starts at $100. In the example, the index falls 20% on the first day, then rallies by 20% on the second day. After the 2 days, the index price is back up to $96 for a minus 4% total return. On the other hand, a 3 times leveraged ETF tracking the same index would be down 60% on the first day and up 60% on the second day. The total return would be a net loss of 28%. That's much greater than 3 times the loss of the original index. The Investopedia article also explains this phenomenon. This is called volatility drag. The article goes through another almost identical example with a 2 times leveraged SSO ETF. This type of example, where an index goes down a percentage on one day and then up the same percentage on the next, and the resulting severe...
Yeah, so, okay, so like he gave the term for, right, volatility drag. That is real, that is true. It's still also misleading to say, leveraged ETFs, volatility drag. You see what I'm saying there, right? Just slap a sticker on there, volatility drag. To characterize the situation of leveraged ETFs by primarily looking towards here's volatility drag is very misleading because that is not the nature of the stock market. This is true, mathematically, this is true. That if it is flat and stays, right, doesn't go anywhere, stays stagnant, that the leveraged ETF will show, and also, by the way, mind you, 30% in 1 day is not happening. because 10% in one day isn't happening. That doesn't ever happen. There was one time, literally one time, that I think ever throughout history that a flash crash happened in the larger markets, 1968 or something like that, and it was because of like computing errors. But now they have things in place for that, breaks of sorts, because that happened. Anyways, though, point being, so this is a bit of an extreme example, but you kind of get the picture of volatility drag. It's misleading primarily because of this fact. The stock market, since its very inception, has consistently gone up. Yes, there have been times where it was flat, but over the long period, right, if you look at a section of here's 5 years, here's 10 years, right, it goes up. It goes up. That's what the stock market does, because the economy is growing, because we have a larger population, because our, anything outside of something that is world ending, the market will continue going up. These companies will continue to make money. They will continue to grow, as they always have throughout history. That's something that's pretty reliable. It's called inductive reasoning. It's what science relies on. So it's something that you can have something of a degree of comfort in. Are there going to be periods where it's kind of flat again for a short amount of time? Yes. Over the longer term, though, it doesn't matter. We should all be long-term holders anyways. There's only effectively one exception. I talk about that on the cards, funny enough. Of times when there is, something really big and bad, right? There's a pandemic, world-ending news, or significantly bad world global news, or the stock market gets into too high of a bubble, right? Too much. We can look at valuations. We have the fucking internet now. That is powerful, right? You can look at the Warren Buffett indicator. You can look at the Q ratio. You can look at the Shiller P&E. You can see these things when they get up too high, and you say, I'm going to take out little chunks over time, just a little bit, and be more safe in my stuff. And you can figure out how you want to take that money and put it somewhere else. Maybe do real estate, whatever, right? Doesn't matter. Point is, though, is that we're a whole lot more advantaged now than really ever before. And volatility drag, very misleading.
Their underperformance of the leveraged ETF is a classic example used to tell people that leveraged ETFs are inherently underperformers. So now let's investigate these claims to see if they actually mean that long-term investors shouldn't use leveraged ETFs. The daily rebalancing of the leveraged ETFs means that over the long term, a 3 times leveraged ETF will not give 3 times the results of the underlying index. There are many articles, including 2 that we just saw, that give examples of when the leveraged ETF will severely underperform the daily leverage ratio. But then why is it that the 3 times leveraged S&P 500 ETF, the SPXL, is up more than 2,300% since inception in November of 2008, while the unleveraged SPY ETF is up only 338% in the same period? That means that the 3 times leveraged ETF actually outperformed the underlying index by a factor of 7, which is actually even better than the
And this is, again, over the period of 10 years, do 20, do 30, do 40, right? The point about these is exactly the nature of compounding interest. This is what it does on a day-to-day basis. That's exactly how they function. Compounding interest. It was Einstein who said that compounding interest is the 8th wonder of the world. This is 10 years. Give it 20. That 7 times could turn into 20, could turn into 25, maybe even 30. Who knows, really? But the point about it, though, is that that sort of figure is just the beginning.
3 times positive return of the SPY by a long shot. So clearly, the volatility drag doesn't always hurt investors. Now you might say that that's an unfair comparison because the same period since SPXL was started was one of the longest and most intense bull markets in history. Later in this video, we'll do a study looking all the way back to the 1920s, before the Great Depression, and see what happened then. But if we look at another leveraged ETF, the 2 times leveraged SSO, it was made back in June of 2006, right before the Great Recession. It is currently up 523% since inception. In the same period, the underlying S&P 500 index has experienced the 2008 financial crisis and the coronavirus sell-off, and yet the 2 times leveraged ETF is still up significantly. In fact, again, it outperforms the 2 times daily leverage ratio, returning 523% as opposed to 230% for the SPY. That's an outperformance of 2.27 times, which, like the 3x leverage ETF, actually outperforms the nominal daily leverage ratio since inception. The reason is that the daily rebalancing of the leverage ETFs is not an inherently money-losing process. There's an entire academic field of mathematical statistics devoted to studying. So theoretically, on average, before expenses and management fees, a 3 times leverage ETF.
Professional traders who trade full time
the same
for a
guy.
living
It's
do
crazy.
not drive Lamborghini.
ETF should return exactly 3 times the return of the underlying index. That is a mathematical fact based on certain assumptions on the stock market. If you want to know what the exact details are, the assumptions include that the underlying stock index is something called a discrete time martingale, and your trading strategy is a separate point about leveraged ETF expense ratios being high. For example, the SPXL 3 times leveraged S&P 500.
He's just talking about the fact of expense ratios. So or not expenses, operating expenses, that sort of thing. Anyways, quick point about this one is that if you look at the the expense the expenses, again, fees and expenses of leveraged ETFs versus something like SPY or something like even some of the ARC funds, yes, it'll be higher by a smidge. ARC is like 0.75, and you'll see vast majority. I've looked through so many of them. Basically, every single one is just like actual smidge over 1%. It's like, who cares?
ETF says in its prospectus, the holdings of the leverage ETF are very complicated and have to do with financial derivatives and leverage. The actual expenses of the leverage ETFs may be more or less than the stated amount. To show the impact of the fees, we simulated the returns of a 3 times.
And it's just looking about like, but what happens if they didn't take the fees out? And it's like, well, here's the red line, but here's the blue one, and then here's the SPY down here. All right, skip this part though.
In the unleveraged stock market trough of the great financial crisis. After this, the market achieved a historic bull run and the SPXL benefited tremendously. Obviously, past performance does not guarantee future performance. In periods where the SPY does not perform well, the returns of SPXL will be much lower. Yahoo Finance provides daily price data for the S&P 500 going back almost 100.
So this is and so what he uses data for is to show us the comparison of like what the SPY did versus what SPXL did through the Great Financial Crisis, the Great Depression, and every single recession since then, and then through the dot-com bubble, massive bubble bigger than this one, and then the Great Financial Crisis and COVID, and you'll see what the results are.
Years to 1927. With this data, we can simulate the hypothetical returns of SPXL going back to 1927. This will allow us to see how it held up during financial downturns such as the Great Depression and dot-com bubble of 1999. This bar chart shows the yearly returns of the S&P 500. The return is only 100 of its back and 3 for the grip. And the 3 times leveraged ETFs can far outperform even 3 times the long-term results on the market. But in other market conditions, it can almost bankrupt its investors. Buying a set amount each month or each ETF with the same effective.
And there it is. Okay, so he also, before I went to this, he made a good point, right? Is that during some time, so for example, if you would invested all the way up there, like crazy, you would, there it is, right? So of course, funny enough, right? But regardless, the point is though, is that you don't have to worry about that. Why do you not have to worry about that? Because you have the fucking internet. Because you have the Warren Buffett indicator, because you have the Q ratio and the Schiller P&E, and you have all these YouTubers and all these resources and all these different perspectives. I have like a number of different YouTubers that I follow, and they really help because they give a number of different perspectives, different eyes on the market, and different ways of looking at the market, of understanding like what's going on, and all these different indicators that they have that I don't even have access to. It's good. It's very, very, very good. So because of that sort of thing, as long as you aren't stupid and greedy, thinking like, let me invest more, it's gonna go up forever, right? As long as you don't do something stupid like that, you'll be just fine, right? You just have to have your head on your shoulders and a good head at that. But, believe me, like the internet will help you have that good head. So regardless, also no, that wasn't a sex joke. Regardless though, the point is that you'll be doing just fine. But yeah, look through every single recession that's like ever happened, just holding, and actually it's okay. I'll just let it play.
The fees that we observed in SPXL. Going back,
There it is.
investor with less than $500,000.
So if you had done it, invest $100 each year, right? The expense ratios and everything else accounted for, you'd end up with, I know there's a blue line down here, don't worry about it. The point is though, is that as the math works out, the S&P 500 would have been about here, this line, would have been right here, and the ending balance for this would have been $13 million, right? The S&P 500 would have ended at about 500,000, right? 13 million. And again, that is still holding through every single recession that there has ever been and every single massive dumb bubble that there's ever been